Let's take you to the markets to give you a sense of the movement. I'm now joined by Warwick Lucas, who's head of private clients at Vunani Securities. Warwick, a very good afternoon to you. Thank you so much for your time. Oil, war and the return of inflation. Brent crude oil has moved back towards the $100 a barrel as the US-Iran conflict intensifies. And of course, the Houthi activity threatening shipping. Are we approaching another genuine global energy shock, or could this be an instance where markets are still assuming that the physical disruption to oil supplies will remain manageable?
I think we're closer to the danger zone, but we're not yet in a full energy shock, because I think markets are currently pricing in quite a lot of disruption, but not yet the reality of a full sustained supply breakdown. I mean, look, oil's moved higher because traders are worried about two particular points: the Straits of Hormuz and the Red Sea, and the shipping through that. But a full-on energy shock, for example, would entail both Israel re-entering the war and an even higher level of combat, real gloves off, I would think. So a true energy shock needs a bit more than fear and scrappiness. It needs a real actual and sustained disruption, a lot less barrels getting to the market, and a massive shortage that just feeds straight back into diesel and transport and food prices and so on. So far the markets kind of think that this physical disruption, A, can be managed, and B, might very well be or have gone to a brink where the participants are going to pull back from. But it's definitely a bit of an inflection point. I mean, just one more push and we're looking at $120 oil again.
I mean, it was only just recently that markets were only debating when central banks could cut interest rates. Higher oil prices have now raised the possibility that the Federal Reserve may have to increase rates again. This move, again, talking to the Middle East conflict on the global interest rate outlook.
Well, I mean, it certainly matters because it shifts the interest rate discussions. I mean, a few weeks ago, investors would be asking, well, when can interest rate cuts start? And now the question shifts to, well, could inflation force central banks to either stay higher for longer or even keep on hiking? So, I mean, the Fed would not normally raise rates just because oil had one or two bad weeks. I mean, central banks know they can't control oil wells and shipping routes and wars, but they do care if higher oil prices start changing your systemic inflation expectations. And if fuel and transport prices follow through, then that's a broader inflation problem. So that's why this conflict matters, but also the duration of the conflict matters. A quick end is clearly desirable.
Yeah. And the discussion around interest rates, a big one, a big talking point here in South Africa today more than ever. And the European Central Bank, which is also expected to leave rates unchanged today, but may warn that another increase could follow if energy prices continue rising. How does a central bank distinguish between a temporary oil price shock, which it cannot control, and the beginning of perhaps a broader inflation problem that requires higher interest rates?
Okay, so central banks like the ECB and SARB look for so-called second-round effects, which is when a temporary shocks or one-off shocks have filtered through and started raising expectations. So, temporary shock's painful, but it can be looked through if it's going to fade quickly and doesn't change behavior. But the danger comes when higher oil prices start spreading and transport companies raise prices, food producers raise prices, and farmers as well, workers demanding compensation for higher living costs and so on. So central banks will watch so-called core inflation and other such measures. And if they think that they are becoming stickier, they will definitely get involved. And in the case of South Africa, of course, there are lags in how our inflation is determined and the drivers of our inflation compared to uh, other developed markets.
And Warwick, very quickly before we let you go, when it comes to AI earnings, Alphabet has reported strong cloud growth, but its shares came under pressure after it raised expected capital expenditure, while Tesla disappointed investors. I mean, what should we make of this when it comes to the technology giants?
So, I mean, the question of the contribution of AI to earnings, I mean, is clearly important here because it's generating an impact for sure in terms of bottom lines, but still costs an awful lot of money. I mean, the Alphabet cloud performance shows that the companies are spending very heavily on AI infrastructure, data processing, and computing power. But the question is now, well, how much money must be spent to earn that growth? And I think that's what we're seeing being reflected in the share price responses here. That clearly the revenue is real, but so is the cost of earning that investment return. So it's still a bit of a trade-off between cost and benefit.
Thank you very much. Always a pleasure to have you on the show. Warwick Lucas, Head of Private Clients at Vunani Securities, giving us a sense of how the markets are faring.